Hello folks, I'm L.A. Little and this is your weekly NeoTA wrap. We take a look at these markets and we do it from a neoclassical perspective, each time asking ourselves what happened last week and what does it tell us about the coming one. I do this show every Sunday night, broadcast at or before 10 o'clock Eastern Time. It's archived on YouTube, available to you there under the channel L.A. Little. Just subscribe, anytime content's pushed, you'll be notified. As far as these markets, pretty big down week last week. Let's look at the numbers. What you're going to see here is, big, fat, blistering move to the downside. Down for the year, down for the month. Not a nice way at the end of the month. Pretty good broad-based selling across all the indexes. Moving to the charts, let's take a look at what's happening here and maybe what it portends with respect to the near future. Let's look at we'll start with the S&P 500. I've been talking about, and talked about it last week, the possibility and the probability of a potential faster move down setting up, right? And it's these swing point lows here and here, and it's also the swing point lows on the weekly. So if we pop up the weekly and look at that, you can see them now. You remember I was telling you this one would print. Well, it's printed. So 1972 is the number. We're at 1994, 1995. At support, right, on the weekly, it's going to try to hold. Whether it does or not, we'll see. I see volume, increasing as we're coming down there. The lows of October are a long way away. If this thing wants to rock down that way, there's going to be other swing point lows to be looked at as we get down there. And what I'm speaking of in particular, if you remember when we came down in October, we broke this swing point low that moved us to a sideways trend. That was on this break. We did not break this swing point low or that one or this, the one we just created. So if you take that in context now, you have two swing point lows here plus this one. If this starts rocking this way, there's a lot of swing point lows down on this time frame. Now let's take this one step farther. And since this is the weekly show, we try to look a little bit farther out. And that is the monthly. So if we look at the monthly chart, now let's just assume, we're just starting February. Usually the first 4 or 5 months of the year are pretty good. Let's assume that this thing is able to hold above the October low into, say, April or something, and we print this as a swing point low. That October low, that low is 1820. 1820, that's also, this price point here on this bar. We could take out this one on a fast move down, but I doubt we're going to take out this one and this one together. If that were true, then what would you have? You would have the potential for multiple swing point lows potentially breaking on this time frame, right? And if this one prints, it would also be on this time frame as well. Folks, we haven't seen that since 2007, 2008. That's the kind of setups that should keep you up at night, right, if they form. Now, we're a long way away from that forming, and it's going to take a while if it does form. But that's the sort of, forward-looking stuff you need to do to try to realize where things could go and what kind of risk there is, especially if it begins to lay out that way. Right? Nothing says it will, but if it does, it's an issue. And that low that's already printed out there is 1737, which is this low. So, we don't even have to, on the monthly, this monthly doesn't have to print this one as a swing point low. This one's not that far behind, right? It's only another 70, 80 points down. And if you think about this advance, just take the top bottom. The low is 1074, high was almost 2100, right? So 2093. So again, what we got? 1074, 2093. what is that, 1,000 points? 1,020 points? Okay, so we should be able to take about half of that away and still be a bull market. Half of that is 500 points. That's not a small number. So you can see that, you know, we're very elevated and we could get a very big drop at some point. And still, this market would only be giving back half of what it gave you, right? And only half of what it gave you since 2011. A little bit less than half of what it gave you since 2010. We're not even going back to the bottom in 2009. If we wanted to do that, and we wanted to take half of the advance from 2009, that would bring you back into where support shows here. Why is support so far away? Because there's nothing on the way up. There's nothing on these monthly charts. There is no support higher. There's just nothing up there. Nothing significant enough to create support zones. You got to go 700 points down to find one. If you don't believe there's risk in these markets, you're just not, you know, looking at reality, in my opinion. Doesn't mean you have to run and jump. It doesn't mean it's going to be this time. But it is out there. The risk is out there. So something to think about. All right, let's move on to the other indexes. So now that's the S&P, right? If I took a look at the NASDAQ, right, you've got the same sort of setup here on the NASDAQ as you do on the S&P. You got a swing point low, another one here, another one there. 3 of them, all lined up, and they're not all that far away if this market wants to make the decline. If you look at it on the weekly, you've also got a swing point low there. Coincides. So in other words, if you start to break these swing point lows and they all collapse together, it's going to be a faster move down. That's the risk in this market, and that's something you should be aware of. It's true on the NDX. It's also true on the Russell. They're not all set up the same way, but they're similar. And that similarity is going to create a big problem if these things start to cave in. Because once you get, you know, if you remember back in September, they weren't set up that way, right? In September, you basically had the Russell trying to break down and everybody else was fine and happy. And, you know, if we pull up the Russell back on the weekly here, you know, this was the setup on the Russell. Remember all the swing point lows? When it broke, it was a faster move down, right? And then, of course, you know, in this bungee market of ours, it just came flying back up. But the situation is not the same now, and I'll have an article out probably tomorrow, you know, detailing more of this, but, you know, it's not the same. And, you know, one has to be concerned with what is and isn't going on with respect to these markets. Let's look at the sectors, because, you know, if you're looking at just the overall markets, you know, it looks a little concerning. If you look at the sectors, you know, do they support that concern? Well, here's the IBB, and the IBB just went up and made a new high last week, so it's not like these guys are fearful, and they did it with more volume, which says they're going to try to get back up there and do it again. You had a big earnings blowout on Biogen, you know, to the top side. Amgen was kind of struggling, some of the others as well, but, you know, this sector, not too bad a shape. And if you look around, it's about the only sector other than the XLU, which actually got hit on Friday. But if you look at the XLU on the weekly, that's pretty strong as well. Turning back now to sectors that are struggling, and that's most of them. And I'm gonna leave up the dailies. Well, let's look at the weeklies actually. So let me pull it over. So here's the weeklies. Now, a lot of these, remember that bungee move back up off the October lows? It was so fast and furious that it wasn't able to create swing points on the way back up. But essentially, those were highs, right? And now we're coming back in and testing those highs. It serves about the same point. Back when I was developing the neoclassical thought, it was a close run between 5 bars and 6 as to whether you print a swing point or not. So in other words, if we did 1, 2, 3, 4, 5, that would have printed. But 6, it doesn't. It doesn't change the fact that that was quote unquote kind of a quasi, if you will, swing point. And I don't say that to somehow make up for the fact that we did 6 instead of 5. We did 6 because we wanted to err on the side of conservatism. Almost everything I do errs on that side, right, on conservatism. So, you know, that's the point here. But the fact that it's coming back in and testing that level, and you'll see this on a few of these charts, that is a significant level. If it breaks it, just as if it were a swing point high, if it breaks and doesn't hold, it's going to do the same thing across all of these. So IYT looks that way. If we look at the XLF, the financials, they're already below, and it did print swing point high here because it was a weaker one. That one has already printed now and gotten below it. So that retest regenerate zone, which is the prior swing point high's low, it's underneath it, breaking down, coming after these October bars. If we keep going right through all these sectors, they're all looking the same way on the weeklies. Here's the industrials. That little green line, the support line, that's the line in the sand. If it doesn't hold there, there's not much up underneath it. If we keep going, XLK, you got the same setup here, right? It's barely hanging on to the bullish retest regenerate zone, which is the low of the prior swing point high. Moving on over, how about something that's safe, right? The consumer staples. Well, they're coming after a swing point low. Now, this has been one of the strongest on the upside, along with the utilities. Safety plays have been in vogue, but we just saw Chevron, for example, suspend their dividends. Are we going to see other companies do that? Maybe that's why we're starting to see the staples begin to turn a little bit. Maybe they're not as safe as everybody thinks they are. And then with the biotech, you actually got pretty good strength in the drug stocks, the healthcare stocks, although they are starting to come back now. And then if we go over to another sector that should be screaming higher, they also are testing the prior swing point high, so far holding on to it, and that's the discretionary. And I say they should be screaming because of oil being so low. And speaking of oil, let's look at the XLE. XLE is down here still testing the lows, can't break it down. XLE still looks like it's going to try to bounce. And if we look over at the XLB, this chart is a mess, and although it is holding, there's nothing special about the way it's holding. A lot of chop up and down. A lot of the concern is centered around oil, and if we look at the oil stocks, they actually, on a weekly, they made a lower low, but they actually left more volume. That says, once more, that they're probably going to come back down there and try to test that low again. If we look at it on the daily, it doesn't have to be immediately, but somewhere down the road. If we look at the daily, you had another huge push up, looks like another short covering rally, comes after a hammer reversal the prior day. It was a nice setup, actually. One of the members called it, and I didn't pay enough attention because that was a nice move. Almost 7% on Friday. Swing point high is here. To get anything going, you need to get over swing point high. Prior swing point lows high, 1773, closes at 1782. So this is the first case we have seen now where oil has been able to get back over and do something on the positive side, and that is it got back over a swing point lows high, breaking the retest regenerate back to the downside. So that says what? Says it should be in some sort of a sideways range now. Where could that take it? I think this area here is the area that you want to be looking, and that's that swing point high. So a little bit farther up, and potentially all the way back up to the prior breakdown zone, right? These are the big bars. That would be where resistance would be on the way back up. big time resistance, right? If it can get up there, and that would be a heck of a run. That'd be what, $4 on a 16, 25% move. That's the kind of insanity that exists in that market. Speaking of insanity, how about the dollar? The dollar is supposedly is the culprit to corporate earnings. Big bar here, trades back into that bar, flips back up, coming back up, going to try to test again. That's going to be a big tell if it can get over it or it can't. And if we look over at the flip side of that dollar FXE, it looks like it's going to hold there for a little bit. And the Swiss is coming back in, doing some gap filling. That actually looks like a buy at this point. And then going back to, I wanted to look at the yen. Where's the yen? Here's the yen. And the yen is basically trading sideways. So dollar looks like it's probably going to take a break. And then finally going over to the bonds themselves making new highs. And if we look at those on a weekly basis, just legging higher and higher, volume expanding. I don't know what's going to bring these back. Part of it's fear, part of it's demand, and that's without the Fed adding any extra demand, just existing demand that they have. But bonds, you can't get anything in Europe. You might as well buy it here, right? And I suspect a lot of the European money is flowing into our bond market and keeping it higher. And it's not just, it's not just TLT. Just look across the board at all these municipal bonds. Look at corporate bonds, right? The high quality corporate bonds. Even the junk bonds aren't doing too bad. But certainly not the same. But and if you look at the bonds themselves, go across the yield curves, they're making highs. This is the 3 to 7s, the 7 to 10s. They're all skying. Even the 1 to 3s are finally going back after that high, and that spike high that on October, in this case it was the 13th, but it was the October lows in the equities where fear was running rampant. What are we doing? We're coming back up there to test them again. All of that, if you didn't need any more, all of that tells me just the same thing I echoed Thursday night, and that is if you don't think this market is going to try to break out those lows, I'm not sure what you're basing that on, because everywhere I look technically, without the Fed intervening last week in the sense of trying to talk the dollar down, right, this market is going to struggle. Now, the savior, if there's going to be one this week, it's going to be all those Fed officials hitting the road like they always do the week after the Fed meeting and start their doublespeak and start talking about how, it's going to be this and it's going to be that. Although they just told us that it's all data dependent and they don't see any reason to change their statement. Now they're going to come out and they're going to soften that statement probably this week. So if this market finds some relief this week, it's going to be off that pack of Fed officials getting out there in front of the media and trying to talk this dollar down. We'll get the first one on Tuesday. We'll see if that makes a difference. If they don't talk it down, I think these markets are going to go after those lows faster than you think. Okay, so I'm probably going to leave it at that today. I think that's a good broad picture. Where are we going? Unless those Fed officials really do something, we're going to go take those lows and we're going to take them on. And we're going to try to break them down. If we do break them down, we have the potential for a faster move down. The structure is in place again. And that structure, even though it's not a sufficient condition, it's a necessary one. And it's there now. Will it or will it not? That's the question. It won't take long. We'll find out this week or next, I would suspect. And you got a lot of you got two other factors I didn't talk about that are playing into that this week. A lot of economic data. Economic data, for the most part, has been negative for the last 5-6 months. Chinese data PMI released on Saturday went negative. So it doesn't look like that trend is changing. The other piece of its data is the economics, the earnings. Earnings so far have been sold almost straight across the board. This is the last big week of earnings. Energy companies in spotlight. Next week you have the retailers, and that's pretty much it. We may get a little bounce out of the energy names because they're so oversold, and we're getting a little flip around now in the oil. So that may be a little relief this week, but don't look for these earnings to take this market higher in any sustained way. This market, when it's sold across the board, it's no different than, you know, I always put up, and I've talked about this before, but on my and I can pull this over, you know, on this chart, these shared watch lists, basically, right? The watch lists that are over here. So these watch lists, I have a bunch of watch lists for myself that I use to, you know, monitor the market, which is also what I talk about on this show. You know, but I have earnings that I believe are significant, and like Apple, you know, Apple was a positive one. ABC was a positive one. ACT is positive. But if you keep going down my list here, you're going to see a lot more negative ones. What does that mean? Well, when a stock is positive, it tends to be positive for the next 3 months until the next earnings. When a stock is negative, it tends to be negative for the next 3 months. If you look at the number of stocks that are negative and positive, there's more negative than positive, and the result, you know, that reaction therefore is probably going to be more negative than positive over the next 3 months. It's the same for the whole, the aggregate, as it is for the individual. And so from that perspective, I suspect earnings are not going to entice more money into this market in the next 2 to 3 months. All right, that's it for tonight. Have a great one. Thanks for joining me. Tell a friend, tell two. I'm LA. This is and was your weekly NeoTA wrap. Have a great night, and I'll see you next time. Good night.